On the evening of August 15th, 1971, a Sunday, Richard Nixon, the 37th President of the United States, interrupted regular American television programming to deliver a statement lasting approximately 17 minutes. In that address, he announced the suspension of the dollar's convertibility into gold. The fixed rate of $35 per troy ounce of gold, the anchor of the international monetary system for 27 years, ceased to exist. The historians would call it the Nixon Shock. The economists would call it the end of Bretton Woods. The central banks of 14 nations called their finance ministers at midnight. No one called it what the historical record required: monetary debasement. The same structural event that destroyed the Roman denarius, mortgaged the Habsburg treasury, and ended British imperial finance. A different mechanism, the same sequence. Before understanding what the dollar's gold convertibility meant, consider what a pawnbroker's receipt represents. A depositor places something of value, a gold watch, and receives a paper receipt entitling the holder to reclaim it at a fixed price. That receipt circulates. People accept it as payment because they trust the pawnbroker will honor the redemption. Now imagine the pawnbroker has issued 10 times more receipts than there are watches in the vault. The moment anyone demands the watch, the system fails. The Bretton Woods dollar was that receipt. By 1971, the vault was nearly empty. How did the world's most credible monetary system arrive at the edge of collapse in less than 3 decades? The Bretton Woods system was constructed in July 1944 at a conference held in the town of Bretton Woods in the state of New Hampshire, a mountain resort converted into the meeting place for finance ministers and economists from 44 allied nations. The conference lasted 3 weeks. Its central achievement was an international monetary agreement. The currencies of member nations would be pegged to the United States dollar at fixed exchange rates, and the dollar itself would be convertible to gold at $35 per troy ounce. The United States government would honor that conversion on demand for any foreign central bank. The system provided the post-war world with monetary stability for approximately 15 years. Then, a contradiction built into its design began to surface. In 1960, Robert Triffin, a Belgian-American economist at Yale University who had previously worked at the Federal Reserve Board, published a short book titled Gold and the Dollar Crisis: The Future of Convertibility. Triffin's argument was precise and devastating. For the Bretton Woods system to function, the United States had to supply the world with dollars, the reserve currency that all other nations needed to conduct international trade. The only way to supply those dollars was to run persistent balance of payments deficits, to spend more abroad than came in. But those deficits accumulated as dollar liabilities held by foreign central banks. Over time, those liabilities would grow until they exceeded the gold reserves backing them. At that point, the credibility of the conversion promise would collapse. The very mechanism that made the system work, the supply of dollars, would eventually make it fail. This structural contradiction became known in economic literature as Triffin dilemma. A balance of payments deficit is the national equivalent of a household that consistently spends more than it earns, financing the difference with credit. Each year, the credit balance grows. Each year, the household remains solvent. until the creditors begin to doubt that the balance will ever be repaid. Triffin understood that Bretton Woods contained the same inescapable logic from its inception. What happened between 1960 and 1971 to turn Triffin's theoretical warning into an acute political crisis? Between 1960 and 1971, the United States financed the Vietnam War, the Great Society domestic spending programs, and the global projection of American military power simultaneously without raising taxes sufficiently to cover the combined cost. The result was exactly what Triffin had predicted: persistent balance of payments deficits that exported dollars abroad and steadily drained the gold reserves held at Fort Knox. In 1950, the United States held approximately $22 billion in gold reserves. By August 1971, that figure had fallen to approximately $10 billion. Meanwhile, foreign central banks held dollar claims that exceeded the remaining gold reserves by a ratio that had become untenable. The French government, under President Charles de Gaulle, had already begun converting its dollar reserves into gold in the late 1960s, exercising a legal right under the Bretton Woods Agreement. Other nations began to follow. In the summer of 1971, the United Kingdom formally requested conversion of a substantial portion of its dollar holdings, a request that, if honored, would have required a significant fraction of the remaining American gold reserve to leave the country in a matter of days. On the weekend of August 13th to 15th, 1971, Richard Nixon convened a secret meeting at Camp David, the presidential retreat in the mountains of Maryland, with his senior economic advisors. Those present included John Connally, the Secretary of the Treasury, Paul Volcker, then serving as Undersecretary of the Treasury for Monetary Affairs, and the economist Herbert Stein, among others. The decision reached that weekend was not incremental. Nixon would announce the immediate suspension of dollar-gold convertibility, impose a 90-day freeze on wages and prices, and place a 10% surcharge on imports. The gold window would close. No foreign central bank would be able to exchange its dollars for American gold at any price. The anchor was gone. What were the structural consequences of removing that anchor? When a currency loses its fixed relationship to a physical commodity, to gold, to silver, to any external standard, it does not immediately collapse. The collapse is a process, not an event. In the months following August 1971, the major industrial nations attempted to re-establish a set of fixed exchange rates through the Smithsonian Agreement of December 1971, which Nixon described publicly as the most significant monetary agreement in the history of the world. The agreement lasted 14 months. By March 1973, it had dissolved. The world's major currencies began to float against each other and against the dollar, meaning their value was now determined entirely by markets, by policy decisions, and by the confidence of international investors. No external anchor existed. Barry E. Eichengreen, an economic historian at the University of California at Berkeley, and the author of Exorbitant Privilege: The Rise and Fall of the Dollar and the Future of the International Monetary System, published in 2011 by Oxford University Press, documented the post-1971 transition with precision. The dollar retained its position as the world's primary reserve currency after 1971. But the basis of that position had changed fundamentally. It was no longer backed by gold. It was backed by the credibility of American institutions, the depth of American financial markets, and the absence of a credible alternative. These are not fixed quantities. They are variables subject to erosion. The inflation that followed the Nixon shock was not immediate, but it was structural. The Consumer Price Index had registered approximately 4% in 1971. The first oil shock of 1973, itself accelerated by the dollar's devaluation, since oil was priced in dollars and exporting nations demanded compensation for their lost purchasing power, drove prices sharply higher. By 1974, annual inflation had reached 11%. It subsided briefly, then returned. By 1980, the United States was experiencing an annual inflation rate of nearly 14%. Milton Friedman, the University of Chicago economist whose 1968 presidential address to the American Economic Association, published in the American Economic Review, remains the foundational modern analysis of the relationship between monetary expansion and inflation, had identified the central mechanism years before Nixon acted. Monetary expansion, Friedman demonstrated, does not produce inflation immediately. It produces inflation after a lag, long, variable, typically between 6 and 18 months, sometimes considerably longer. The mechanism Nixon initiated in 1971, removing the constraint on dollar creation, embedded that lag into the decade that followed. The inflation was broken only by Paul Volcker, appointed chairman of the Federal Reserve in 1979, who raised the federal funds rate to nearly 20%, triggering the deepest recession since the Great Depression. The cure confirmed the diagnosis. The inflation that followed the Nixon shock was not an accident of external circumstances. It was the predictable consequence of removing a monetary anchor without replacing it with any equivalent discipline. The sequence was not hidden. It was documented in real time by economists who had predicted it years before it occurred, in publications that remain available today. The variables that produced the inflation of the 1970s, the removed anchor, the unconstrained monetary expansion, the eroding purchasing power, were measurable at every stage of the process. The question is not whether those variables were present. The question is whether they remain present now. Is the Nixon shock a closed chapter of economic history, or does the structural sequence it initiated remain active? Chronos and Capital applies the La Specchiatura methodology, a variable-by-variable structural comparison between the historical event and the modern trajectory of the United States. Variable 1, the monetary anchor. In 1944, the dollar was convertible to gold at a fixed rate, providing an external constraint on money supply expansion that no government decision alone could override. In 1971, that constraint was removed by executive announcement. Today, the dollar operates as a fully fiat currency with no external anchor of any kind. The constraint removed in 1971 has not been restored. Variable reads, anchor absent. Threshold crossed 53 years ago and unaddressed. Variable 2, the purchasing power of the dollar since the removal of the gold standard. purchasing power measures how much a fixed unit of currency can actually buy at a given moment in time, the real value of money in terms of goods and services, independent of the number printed on the note. In 1971, before the closure of the gold window, the purchasing power of the dollar was constrained by the convertibility requirement. The United States government could not create dollars faster than it could plausibly defend the gold price, because foreign central banks retained the legal right to demand redemption in gold at the fixed rate. That constraint was removed on August 15, 1971. According to the Consumer Price Index data maintained by the United States Bureau of Labor Statistics, the official federal record of price changes across a standardized basket of goods and services, and one of the primary statistical sources for measuring the real value of money over time, the cumulative inflation from 1971 to 2024 represents a decline in the dollar's purchasing power of approximately 87%. A dollar in 1971 purchases in 2024 what 13 cents purchased in that year. No comparable peacetime purchasing power destruction occurred across any equivalent 50-year period of American history before 1971. Friedman's 1968 analysis in the American Economic Review identified the removal of external monetary constraints as the structural precondition for precisely this outcome. Variable reads, "Purchasing power erosion at a rate without peacetime precedent in American history, occurring entirely within the period following the removal of the gold anchor." Variable 3. The dollar's share of global foreign exchange reserves. In 1971, the dollar constituted approximately 80% of global foreign exchange reserves held by central banks worldwide. According to data published by the International Monetary Fund, that share had declined to approximately 58% by 2023. Eichengreen's research on reserve currency transitions, specifically the pound sterling's displacement by the dollar between 1919 and 1956, documented that reserve currency declines do not occur as abrupt events. They occur as gradual, non-linear processes spanning decades, often invisible until the transition is substantially complete. Variable reads, "Reserve share declining on a trajectory structurally consistent with historical transitions." Variable 4. Federal debt as a share of gross domestic product. Gross domestic product is the total value of all goods and services an economy produces in a year, the broadest measure of national economic output. In 1971, United States federal debt represented approximately 35 to 40% of gross domestic product. By 2024, that figure had exceeded 120% of gross domestic product, a level not seen in American history outside the immediate aftermath of the Second World War, and at that time accompanied by an economy growing rapidly enough to reduce the ratio within a decade. The current fiscal trajectory does not project that reduction. Variable reads, "Above all historical peacetime precedents." Variable 5. Annual interest payments on sovereign debt. In fiscal year 2023, annual interest payments on the United States federal debt exceeded $1 trillion for the first time in American history, surpassing the total defense budget for that year. Kenneth Rogoff and Carmen Reinhart, economists at Harvard University, whose 2009 study, This Time is Different: 8 Centuries of Financial Folly, published by Princeton University Press, examined sovereign debt crises across 66 countries over 8 centuries, identified the structural threshold at which interest payments begin to crowd out other government expenditures and accelerate fiscal deterioration. The United States crossed that threshold in 2023. Variable reads, at or above the historical danger level documented across 8 centuries of comparable cases.
What does a viewer in possession of these 5 variables make of the present moment? The historical record does not provide instructions. It provides a sequence. Every monetary system that removed its anchor eventually confronted the consequences. Not immediately, not on any predictable schedule, but structurally, with a lag that obscured the causation until the damage had accumulated. The Roman denarius was debased for 40 years before the crisis of the 3rd century made the consequences visible. The Spanish crown defaulted 3 times before its fiscal structure collapsed definitively. The British pound began its decline from reserve currency status in 1919 and completed that transition in 1956, a process spanning 37 years. The lags are long, the sequences are consistent. On the evening of August 15, 1971, Richard Nixon interrupted regular television programming to restructure the global monetary order. The sequence he set in motion that evening has not yet concluded. It is still broadcasting.
The story didn't change. The frame did.